Eli Lilly closed Tuesday, having just announced $3.8 billion across three separate vaccine acquisitions simultaneously: Curavo, Limatech Biologics, and a company called Vaccine Company. 3 targets, 1 press release, 1 trading session. That is not how a company with unlimited runway usually spends capital. The broader market gave LLY no resistance. The S&P 500 held near its prior session's level, with healthcare shares broadly stable. There was no macro shock forcing defensive repositioning, no rate surprise pulling capital away from growth equities. LLY moved into vaccine M&A on a quiet day, which means the decision was internally generated, not externally forced. The 3 targets cover shingles, common bacterial pathogens, and Epstein-Barr virus, diseases that rank high on public health burden but low on pharma investor radar. These are not obesity adjacencies. Shingles treatments already have dominant players. Epstein-Barr has no approved vaccine after decades of research. Bacterial pathogen work is notoriously capital-intensive with uncertain timelines. Dan Skowronski, Lilly's chief scientific and product officer, framed the move as a deliberate strategy to prevent disease at its source rather than treat its consequences. That framing is a direct departure from the GLP-1 thesis. GLP-1 drugs treat a metabolic consequence. They do not prevent obesity. Lilly just described its new direction as the opposite of what made it the most valuable pharmaceutical company in the world. Retail positioning in LLY has been concentrated in the GLP-1 obesity trade. Institutional holders built thesis documents around tirzepatide's market penetration, pricing durability, and competitive moat against semaglutide. The vaccine move does not appear in those documents. The capital that moved into LLY over the past 3 years was not pricing a vaccine company.
The unusual element is not that Lilly is diversifying. Every major pharma eventually deploys pipeline cash into adjacencies. The unusual element is the simultaneous triple structure. Acquiring 1 vaccine company signals opportunistic timing. Acquiring 3 at once signals a capital deployment mandate that needed to be executed before the window closed or before internal guidance shifted. Lilly's free cash flow has expanded sharply on GLP-1 revenue, giving management the ability to write $3.8 billion in checks without straining the balance sheet. But simultaneous triple M&A also compresses integration timelines, splits management attention, and creates 3 separate pipeline dependencies on vaccine stage science, the kind of science with binary outcomes. That is a risk profile LLY shareholders did not price in during the GLP-1 bull run. The participant timing asymmetry is visible here. Lilly's management and its advisors moved on all 3 targets in parallel. Institutional holders had no advance signal. The announcement landed after market-forming consensus had already assigned LLY a GLP-1 growth multiple. Who has not yet repositioned is the institutional base that holds LLY on a pure metabolic drug thesis. Analysts covering LLY as a GLP-1 play have not had time to rebuild valuation models incorporating vaccine pipeline probability weighting and the capital cost of 3 simultaneous integrations. The reversal insert is this. If the GLP-1 market is approaching saturation or competitive pressure faster than publicly modeled, redeploying cash into vaccine M&A is the rational CFO move. Reduce dependence on a single revenue driver before the multiple compresses. The same $3.8 billion that looks like ambition at peak GLP-1 looks like a hedge at inflection. What the press release calls a deliberate prevention strategy and what a portfolio risk manager might call runway diversification before the obesity trade matures are the same cash movement. The question the market can't answer yet is which reading priced the decision, and that uncertainty does not resolve from the press release alone.
The unresolved question from the previous layer is whether LLY management is deploying surplus GLP-1 cash from a position of strength or engineering a narrative shift before the market prices a growth ceiling. Both conditions produce the same announcement. The body of evidence leans toward the former, but cannot rule out the latter. The historical parallel that applies here is Pfizer in the early 2000s, when the company used Lipitor revenue to fund aggressive M&A into adjacent therapeutic areas. That diversification preceded the Lipitor patent cliff by years, and shareholders who held through the M&A phase absorbed significant dilution as the core franchise slowed. Lilly's GLP-1 patent runway is longer than Lipitor's was at an equivalent M&A stage, which is the cleaner reading. But Pfizer also announced its diversification strategy using similar prevention and innovation language before the market had fully priced the patent risk. For the bull case to hold, the verification benchmark is LLY's GLP-1 volume guidance in the next earnings call. If tirzepatide prescriptions and manufacturing ramp remain on the growth trajectory from last quarter, the vaccine M&A reads as pure expansion capital, surplus deployed efficiently with the core engine intact. The $700 billion valuation case does not require the vaccine pipeline to succeed. It requires GLP-1 not to decelerate. The bear case activates if the next quarter shows pricing pressure from semaglutide competition or slower than guided demand penetration. At that point, the $3.8 billion becomes visible as capital that was not returned to shareholders and was not deployed into GLP-1 manufacturing capacity. It went into early-stage binary outcome science. 3 vaccine programs with uncertain phase 2 timelines do not offset a 10% compression in the core tirzepatide revenue forecast. The leaning tilts toward the bull case. Lilly's cash position makes the simultaneous move financially manageable, and the GLP-1 market has not shown deceleration signals as of the last reported quarter. But the lean is conditional. If LLY reports any guidance revision on GLP-1 volume in the next earnings release, the same press release that reads today as strategic ambition reads that day as early-stage distraction. The $3.8 billion already moved. Whether it was deployed at peak GLP-1 or ahead of it, that question won't close until the tirzepatide revenue line does. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.